Ronak Niroy. I head the content activity at Personal FM. Welcome to the panel discussion on exploring investment opportunities in the small cap space. I have the privilege to have with me Mr. Ajit Dayal, the founder of Quantum Advisors Private Limited, which is the sponsor of Quantum Asset Management Company, the investment manager of Quantum Mutual Fund, and Ajit is also the founder of Quantum Information Services, which owns Equity Master and Personal FM. I also have with me Chirag Mehta, the CIO of Quantum Mutual Fund. Chirag has been serving as a senior fund manager, alternative investments, and he has over 18 years of experience and was formerly ranked as the fourth best fund manager in the world under 40 by CityWire in 2017. Ajit and Chirag, thanks for joining.
Thank you.
So let me first begin with Ajit. Let me first ask you, could you provide some insights on Quantum's inception and journey? How and when it all started, the founding philosophy of Quantum, the year when you were granted the asset management license, and why you think retail investors should invest with Quantum Mutual Fund?
Well, firstly, thanks for being here with us on the panel. I'll go back a long time in Quantum's history. So we started Quantum in 1990. And at that time, there was nothing like a mutual fund. There was no mutual fund regulation. SEBI was not born. And the only mutual fund was Unit Trust of India. That was the only mutual. And then there was Can Bank had launched a fund, etc. But there was no private sector mutual fund. So always had this desire to create a mutual fund. But every time we were about to approach the net worth criteria, SEBI raised it. Right. So we were kind of chasing our own tail, and it took us a long, long time to get our license. Finally, we did apply for the license and get it, and we launched our first product, launched it in March of 2006. That was a Quantum Long-Term Value Fund. The reason we set up Quantum was I always was an investor and wanted to share the skills that we built in Quantum to the retail investor base. We've been managing money for foreign institutions since 1992, when we had a joint venture with Jardine Fleming and subsequently with other global firms, but never had the opportunity to share our skill set and what we have to offer with the Indian retail base. So built a team, and we got the license in 2006. We were different from other fund houses. We were the 29th fund house at that point in time. But we said we were the first fund house that really focused on what was right for the investor. And the differentiation factors are, you can even see them today. This will be our 12th fund launch, right? The small cap fund. So most of the fund houses have got 30, 40 funds because they are a factory in some sense, and they're asset gathering. Whereas we come from a different perspective. We have an asset management company license, not an asset gathering company license. So being an AMC, we should have a good skill set, which we can then showcase and put client capital into and investor money into. So it began with that philosophy that we're first and foremost fund managers, research analysts, and we're not marketing people raising assets. So that was the approach, that was the philosophy. Come up with a few simple products, and by aggregating all these products, you come up with a solution. And you're always focused on the investor, you're being transparent, you're working in the best interest of long-term investing. That's the other distinguished factor as opposed to short-term trading or short-term investing.
Absolutely.
I don't think even in our personal lives, we care about short-term stuff. We don't look at markets on a daily basis. We look at it to kind of monitor there's no collapse, but we don't worry about daily NAV, monthly NAV, quarterly NAV, etc., etc. So many different things. The other aspect also, in addition to being investor first, was the various processes that we built. So very structured and very methodical in how we pick stocks and how we construct the portfolio. When I was managing money for Vanguard many years ago, for the Vanguard International Value Fund, they taught us about the 4 Ps. And the 4 Ps are, who are the people behind an investment firm? What is their philosophy? So in our case, thinking long-term, building long-term solutions. 3, what are the processes that they build to convert the philosophy in their head to something usable in real life? And finally, the 4th P was in terms of what is the predictability of the performance of the outcome after you put everything in place. So we took those 4 Ps to heart and are very, very disciplined in how we approach allocating capital, investing money, selecting stocks, building portfolios, etc.
That's nice to hear. And how has been the performance of your equity mutual fund schemes? You limited the number of schemes initially when you launched, and you explained the rationale for that. But how has been the performance of schemes? How has been the experience for investors so far?
So define performance. I mean, if we're looking to beat a benchmark, we have beaten the benchmark. Are we the number one fund house in the company and the country in terms of returns? Probably not. Do we aspire to be the number one fund house in terms of returns? Answer is no. Because everyone talks of performance, like you just mentioned, returns.
Right.
You forget about the risk that you're taking to get the return that you've received. And there's a direct correlation, investment 101. The more risk you take, the more return you should get. And in our case, we address the issue of being in equity stocks by calibrating, by assessing the risk, pricing the risk, calibrating the risk, and then making a portfolio. Based upon the risk we've taken, we're extremely happy with the return.
Wow.
So it's very different mindset from trying to be in the top decile or the top quartile of any fund ranking house. The other day, I was at a conference where one of the large distributors, if I can call it, one of the large platforms in the country, was saying that he's surprised why people are buying five-star funds on his platform. And when he looks at the track record of the performance of what his own clients have done by buying five-star funds, he finds that the index outperformed those five-star funds. The problem is the ranking. This five-star, four-star, three-star is rubbish, in my opinion, because it's looking at certain characteristics which are generally near-term or recent near-term, and based upon that, you're getting a star. And if you're buying stars, please don't buy us. If you're buying and investing long-term capital for long-term, sensible, risk-adjusted returns, please do look at us. Please look at Quantum and understand what we do.
So it's like twinkle, twinkle, little star, how I wonder what you are.
Correct.
So you mentioned about the risk. Chirag, over to you. Can you tell us how do you manage this risk? What is the investment methodology which you follow at Quantum and the risk mitigation measures which you...
Sure. Firstly, the core of any investment is research, right? We do kind of deep dive into what we do, and any product that we launch has a core backing of research to it. Without any good research, or if we not being confident of that research, we will not launch those funds very clearly. Second is, portfolio construction. When it comes to portfolio, there are certain traits that you need to look for and which are very, very important. In bull market, everyone forgets about that, but these are very important traits from a portfolio perspective. For example, liquidity. Are you able to buy in or exit those stocks easily or not? So 3 months is a reasonable time frame for you to build or exit a position. Whether your portfolio size or your portfolio capacity is adhering to those liquidity constraints or not. In the small cap world, when we see, there are many funds which are large owners of companies. They are 8, 9, 10%, not 10%, but slightly less than that of those companies. And if you see portfolio allocation to that is 0.5, 0.6%. So they are very, very suboptimal. We don't want to be those suboptimal weights when we build the portfolios. We need to, give something that is meaningful in terms of its attribution to performance. Right? With the 0.5% weight, even if it doubles, it's not going to add too much to the performance overall. And how many stocks will double in a portfolio?
So typically, what are the number of stocks you hold in your portfolio in an equity fund?
So it depends on different type of mandates that we run. So if it is a concentrated portfolio looking at, bottom up stock picking, etc. And if it is more large capish, probably, 25 to 30 stocks could be the sweet spot. Like you see in a quantum value fund, it has about 25 to 30 stocks usually, because it operates in a space which is very, very liquid. It has a liquidity threshold. It's more in the large cap space, and that is where, that number looks optimal. And basis the liquidity and market cap it invests into, we know the capacity of that fund.
So typically, it's a bottom-up kind of a process which you follow, where you look at the company from a liquidity standpoint, the fundamental standpoint. Can you elaborate on that?
Yeah. So if for any company, I need to get in and get out, given that, defined portfolio weights that I have for each stock. For in a value fund, we have 2 to 6% as a value, as a defined portfolio allocations. In a small cap fund, given it's more volatile, more newer businesses kind of space, we'll have 2 to 4% as portfolio weights in that. So depending on what weights you are assigned and how much capital you will be putting in those stocks, that will determine and whether those stocks have enough liquidity to support that positioning or not. So that will define what will be eventually my capacity, beyond which I will not be the same fund. I will have changed colors.
Right.
So
So
for
if I could just sort of jump
Sure.
in there, I think that we talk about capacity in a very strange way for many fund managers or even for the regulator and for investors. So if you look at a cement plant, automobile plant, they all have a capacity.
Right.
If you produce more than that capacity that is stated or built for, you're not going to get high quality. You won't be what you get. It won't be the final output, won't be what you think it will be. So let's say you want to buy a car and you're looking at a BMW, Audi, Mercedes, Maruti, whatever. If the car plant has a capacity for 1 million, you don't call up Maruti or BMW to ask them whether you got the 100th car or the 355th car or the 200,000th car, because the capacity is a million. As long as you got a factory car made within that million, you're fine. When an investor invests in a fund, the fund house, probably barring Quantum, does not discuss capacity. It's easily calculate. You can calculate it. If, as Chirag explained, you look at the liquidity of the underlying stocks you want to buy. But if you don't look at liquidity and you're in asset gathering mode, you just keep on collecting the money. In BMW's case, they keep on collecting money for cars, and they don't really care whether it crosses 3 million orders when they can make only 1 million. And then the other 2 million cars will be subpar, or all 3 million cars will be subpar.
Right.
So that's the issue with not understanding the liquidity of a stock before you buy it.
Correct.
And Quantum, we built this phenomenal process, which has served us very well and serves investors well, because you know what you're getting into and it's replicable. I spoke about the predictability of the performance, the 4P. That's not possible unless you understand the underlying liquidity of the stock.
Absolutely.
That
Correct.
Chirag just explained.
Correct. So you're talking about liquidity, you're also talking about fund houses have a capacity to manage the number of schemes. In a world where
Yes.
we are seeing so many NFO factories, you limited that with this particular philosophy. Now, given that the markets are kind of at a kind of a peak, and the mood on Dalal Street is pretty much exuberant, you are launching a small cap fund. Can you explain that?
So, define peak. I mean, in March 2006, when we launched the Quantum Long-Term Fund, the Quantum Long-Term Value Fund, the index was at a peak then, 6,000 roughly. Today it's 11 times that, right? So was it a peak then? Yeah. Is it a peak forever? No, because the Indian economy is growing. With growth, you've got companies having more revenues. With revenues, you have companies having more profits. So yes, small caps are at a peak today. Is this going to be the peak for the next 10, 20 years? Probably not. Right? So you've got the economy growing, you've got opportunities. And also in the value fund, when we launched that in 2006, SEBI gives us a few months before which we have to deploy the capital. At least 65% of the money has to be deployed. So we get a few months for that,
Right.
as we had in the case of the value fund. We launched in March 2006, a peak of the market. We waited patiently. We invested some money, but sat on cash for a long time. We looked like idiots because cash earned you nothing, and whatever you invested did well, but cash is 0% rate of return pretty much. And all our peers were fully invested. So their track record and the index looked far better than us. There was a correction in the market in June, July, August of 2006. We were able to deploy the capital, build the portfolio we wanted. And then if you look at the track record of Quantum, over a longer period of time, we did better than our peers and we did better than the index. Not better than all our peers, but better than the index. Now, I go back to what I said before. We're not trying to be in the top quartile or the top decile or the number one fund house in returns. We're trying to be the number one fund house in terms of returns for the risk you've taken. So in March 2006, we didn't take the risk of being fully invested. We took the risk of being in cash. And we were able to deploy that capital when the markets corrected. We found the risk return ratio in our favor to deploy capital then and build out the portfolio.
And that's one of the reasons you also are in the process, or you filed for the Quantum Multi-Asset Fund also. So you
Yes.
want people to diversify their investment into multiple asset classes, equity,
Yes.
debt, gold. Okay, fair enough.
So also, Ronak, to add on the point what Ajit was talking about, today if you see 85% of more than 85% of listed companies are in the small cap space. And if you see, if you have to, looking at the index, I will say that, yeah, it's slightly expensive than what it should be. But if you see, there will be pockets, given the large space that exists there, there will be pockets where there will be opportunities available at reasonable valuations, which will capitalize on and build that 65% that you just spoke about.
Okay.
So we will be patient, judicious, and build portfolio where there is merit.
Right. So can you explain, can you elaborate a little bit on the process which will follow for small cap? How different it will be from the quantum long-term value fund? Or is it that quantum small cap fund will also follow the value style?
So there will be some similarities, like there is a need to look at liquidity of the portfolio. We'll start there. So the liquidity threshold, what we have in value, is very different to what we'll have in the small cap space, because those are two different ball games altogether. So the minimum criteria that we have is stock needs to trade at least 2 crores a day on a minimum or an average over last 12 months. Is the stock will build our universe. We will be cognizant of the fact that we don't want to be more than 5% of the market cap of any company. So those are the constraints that we will work with, and we don't want suboptimal positions in the portfolio. So any position in the portfolio will be minimum 2% and capped at 4% to control the risk. So these are the things that we'll work with. Coming to the next point is governance, because in the small cap space, you can't have a macro overlay and say that this sector looks good and therefore there is enough history for this company, I'll buy that company. In the small cap space, you need to look at what is the governance, what are the promoters, are they trustworthy, and whether they have the ability to execute the orders that they have got or not. One is to getting order, building order book is easy, but to execute and fulfill that order book and deliver that revenue and returns is something very, very different. So governance is going to be a very important parameter that we look at. And here we will look at.
Can you elaborate on governance? You said governance. So how are you going to look at governance issues? Because there are a lot of governance issues in small caps.
Absolutely.
So
if you see, we have an experience meeting managements, assessing them since 1990s, right, as a group. So we will use that knowledge base that we have built overall to kind of assess what promoters we can be confident about and invest in those managements, and whether whether we need to be away from certain kind of groups and companies. So overall, we will meet the companies, we will meet those managements, and without meeting, we will not invest in those companies. We'll do our channel checks in terms of looking at whether they are, how good they are when it comes to business ethics, integrity, etc. And that is where we will invest into those companies.
So if I can just jump in there, which spoke about governance. So in 1996, before we set up the fund, which was 10 years later, as quantum advisors, we built something called the integrity screen within our process when we manage money for international FPIs, foreign portfolio investors in India. The portfolio reflects not only valuation, and not only does it worry about the liquidity of the underlying stock, but also about minority rights and other issues that come up with bad managements. So we haven't owned many of the more popular stocks, the well-known large conglomerate groups who capture the headlines for sometimes the wrong reason. We haven't owned many of those stocks since 1996. And so in a very similar way, that integrity screen will be used, more required, as you indicated, in the small cap space, because managements there have a shorter track record that we can audit and understand. But we've got the experience of trying to figure out how to sift bad management from good management.
So you're taking the G from the ESG investing to G in the small cap ones, governance in the small cap ones, in a sense.
Absolutely.
But my next question to you both is, any one of you can take it, that aren't you worried that in times when central banks are increasing rates, inflation is moving up, yields are moving up, yields are also showing an inversion, which indicates that there may be a recession going forward, and there is geopolitical tension, US, China, Taiwan, China, India, geoeconomic fragmentation looks pretty much apparent. Aren't you worried? I mean, how are you going to address that, and how do you see the markets in the next 6, 8 months or 12 months?
6, 8 months or 12 months?
Yeah. Okay. So typically, because you'll be starting building your portfolio now.
I'll give the long-term answer. Chirag can take a crack at the near-term answer. But since 1980, we've had effectively 11 governments. Right. and across 11 governments since 1980. And I use 1980 because that was around the time when the BSE index had a base, 1978, 79 equal to 100 as a base. So over that period, we've seen the BSE 30 index go from 100 to 60,000 plus, 65,000, 68,000, whatever. And we've had prime ministers in India assassinated. Between 1980 to now, globally, a lot of bad stuff has happened, a lot of good stuff has happened. You've had FX rates against the Indian rupee, which has become very weak. You've had the US dollar strong against the Japanese yen, then weak against the yen and strong against the yen. You've had all sorts of stuff, high interest rates, low interest rates, LTCM went bankrupt, you had the tech crisis, tech bubble, you've had Lehman, you've had so many things that have gone wrong. And yet, India as a country has survived, and I will say will always survive. You've had Indian economy growing at 6.2% per annum over 43 years, compounded average rate. 6.2% has been the growth rate. And you've had the stock market giving a return of roughly 17 to 18% depending which index you look at. So we don't believe that what happens globally is necessarily going to shock India on a long-term basis. The Indian story is very valid and very much, and therefore the thesis to invest in asset classes in stock markets, large cap, mid cap, small cap, makes a lot of sense. That's a long-term view. I'm sure Chirag will have ideas on the short term.
So short term, I mean, we have been through these kind of episodes before as well, right? And if you see, 70% of India is internal consumption. We are very much dealing from the global world. Of course, from flows perspective, we are linked, but otherwise from a growth perspective, we are more internal consumption driven economy.
Right.
And when it comes to that, we are seeing good levers when it comes to Indian markets. Like, for example, real estate is a very important lever and it's working well right now. And it has a cascading effect on overall economy. When someone buys a house, they buy a lot of other things, which kind of makes the economy going along.
Durable and
Absolutely.
all those things. Yeah. Okay.
So real estate, we think that it's been doing well, and that's because of the affordability factor. The affordability prices were stagnant for a long time, and incomes were increasing, which led to the affordability coming back. And from an servicing EMI even at 9%, it still looks affordable.
Right.
So overall, we think that that lever is going strong for us. Second is capex. When capacity utilization exceeds 75%, we have seen that there is a lot of capacities that starts expanding overall. So with the government push on capex, we have seen that there is growth on private capex as well, which will likely continue going forward as well.
Okay.
So overall, we see economy in a good shape. Rural has been struggling, but I think being in an election year and there could be more spending happening, and as it recovers slowly, I think it will also get that momentum in the economy.
So you're saying the long-term story is good?
Yeah, even in the short term, there is nothing alarming except the rural piece.
Nothing to be worried about.
But flows can be, because of the yields being offered at 5%, there could be outflows happening, which we have seen in 2022 already, right? A lot of outflows happened. So that is one piece could derail could have some impact on Indian markets overall from a stock market perspective, but not from a consumption perspective.
Yeah,
So
if you look at what happened at the time of Lehman, right, the Lehman crisis, when Lehman went bankrupt in September 2008, the Indian economy was impacted by probably 0.5% in terms of GDP growth rate. We did a rough calculation, that was our estimate. The Indian currency fell by 25% in 4 months. The Indian stock markets fell by 55% in a few weeks. So money flows, because of destabilization of interest rates in America or whatever it is, can have an impact on stock market prices, but not necessarily an impact on the economy. And eventually, in the Indian case, we've seen if the economy is steady, if the economy is doing well, stock market prices will return up and will give you the rates of return. So if we were to launch the fund now, which is what we're doing, close the NFO, and then have the capital with us, stay steady in cash, like we did, for example, in the value fund in March 2006, right through June, July of 2006. It gives us an opportunity. And it gives the investors who trust our processes and trust our discipline and our history of following these processes, the advantage of saying, okay, these guys know what they're talking about, they know what they're doing, and let's see if they can actually deliver. And I've got these other money, these other mutual funds, small cap funds. Maybe I should reallocate a little bit into the quantum small cap. That's what we hope they'll do.
Okay. So given the brighter picture, gold is also sort of descended. It has corrected a lot. Do you think investors should allocate to gold since you also manage the gold fund? I mean, this is a little away from the small cap fund story which
Yeah.
we're talking about, but
Sure, there are many risks that exist in the global economy, and given that rates where they are, gold is holding well. It's holding on to those 1800 kind of levels very well. Otherwise, if you were to ask someone maybe a year back or 2 years back, if yields were to go to 5%, they'll say gold will collapse,
right.
right? But it's holding very well and recognizing the risk that exists in the global world. So overall, as the US economy has been robust because of certain things, like there were pandemic era savings that everyone got that led to the economy going very strong.
Correct.
That's dwindling now. That's coming to an end to some extent, maybe a 400 $500 billion of more. The housing market, which has been a driver there, is kind of slowing down because so far we haven't seen an impact because rates were fixed at a lower level at 1%, but now incremental growth in real estate is going to be very difficult with rates at such a high level. So overall economy from a US perspective is going to slow down. Inflation could be slightly sticky than what the feds of the world will like to, so we could be staring at a stagflationary kind of scenario. And if that happens, I think the central banks will panic, not because of growth slowing down, but if there is a panic on financial markets translating because of slower growth, they will panic and they will take a U-turn in their policies. So as they start cutting rates, as they start infusing more liquidity, taking a U-turn from the stand that they have now, I think gold should start doing well. So I think it's a good allocate. It's at a good level right now. It's corrected quite a bit. If you don't have allocation, maybe even this is a good time to inch up that allocation.
Right.
So let me just talk a bit more about gold, right? So gold, everyone talks about whether it should be zero, whether it's worthless or whether it's worth something. And what we've seen is that when interest rates increase, the cost of holding gold, which doesn't really give you a dividend, doesn't give you any yield, which Warren Buffett doesn't like it at all, and we disagree with him respectfully on that. He doesn't like gold because it doesn't give any interest. What am I doing holding it if I can put 5% in the bank? That's what's happening now. So people who are in gold are saying, oh, I can get 5% in the bank, so why should I own gold? And they're selling gold. And as Chirag indicated, if you told someone a year and a half ago, that interest rates are going to go from 0.25% to 5%, what will gold be? They would have said, oh, from 2000, probably 1500. But it hasn't. It's held up at 1800 levels. So that again goes to the point of fear and uncertainty. And that's what gold is for. Gold is not about earning a dividend. Gold is a what if in the worst case scenario. It answers your what if question. What if the world is to collapse? What if the Lehmans were to, re-emerge again and mushroom in terms of collapsing companies? Where do I go? You go to gold. Right? You can go to Bitcoin too if you want, but we don't understand Bitcoin. We understand gold, and it's got a history of thousands of years. The other part about asset allocation on the Quantum AMC website, we have a wonderful triangle, a wonderful thing for you to look at, where we allow every individual the luxury of deciding their own allocation in very simple terms. We don't have any risk calculators and behavioral science stuff. Very simple terms. Tell us your monthly expenses. Tell us what will make you comfortable. Do you want to have 6 months of your monthly expenses in safe quantum liquid fund, or 8 months, or 12 months, or 24 months? What do you want? And from that, you have the rest of your portfolio. If you got 10 lakhs of rupees and you want to have 3 lakhs in safety money, then the other 7 lakhs, we give you the nice triangle for you to allocate within equity and gold. And you choose a number. Left to me, and that's what I tell my family and my friends if they ask my advice or my views. I tell them this is what I do for my portfolio. I do 80-20, approximately. 80% in equity and 20% in gold. It moves. I don't check it every quarter, every year. It may move from 80 to 85 and 80 to 75 in terms of equity, and the gold may go from 20 to 15, 15 to 22, etc. But broadly speaking. But if you don't like that, you can change it. And we have all the simple solutions and the simple funds for you to take it from there. So you can design your own asset allocation, as you call it. And within equity, of course, you must have the value fund. Chirag has got an ESG fund. There's a gold fund, of course, in Quantum AMC. And now you got the small cap fund. So some of that equity should also be in small cap fund, which is why we're out there launching it.
Right. So that brings me to the last question. What is the general advice you'll give to investors now that they're opening so many demat accounts, their folios are at an all-time high? So how should they approach mutual funds thoughtfully, sensibly?
Sure. So if you don't have the time, knowledge, and inclination to kind of manage your own portfolio, you go to the expert. You don't self-medicate. You go to someone who can help you with that, right? Similarly, in a mutual fund, if you don't have, time, knowledge, inclination, you go to some expert. So for financial planning, you could go to an expert. For investing in funds or stocks, you go to a fund. If you look at a portfolio construction, there are various aspects of it, right? Like Ajit explained. So probably you could go to a fund rather than dabble on your own, because that could lead to improper stock selection, improper portfolio construction. There could be various things that could go wrong which you have not anticipated when you're trying to do it on your own.
Right.
So overall, we think that you need to asset allocate. That's very, very important, key. And when you do it, you kind of go to an expert in terms of, if you don't have that time, knowledge, inclination. Otherwise, you could have much larger risk than what you're anticipating.
Correct.
Yeah, and just to sort of add to that, if you look at personal FM, you guys have mutual fund research.
Yes.
So if someone doesn't know what funds to buy or what to do, they can subscribe to your research, and other houses and other groups also sell research, and they'll get information on what's happening in different mutual funds. You'll have views on different mutual funds.
Correct.
But you don't really build a portfolio per se for them. So they're getting all the information from you as a subscriber, but they don't quite know how much they should put in fund A, fund B, fund C, flexi cap, large cap, mid cap, etc., gold, etc. When they come to us, we're actually investing in the underlying stocks.
Right.
And we're actually giving them this, like you mentioned, we got the new multi-asset fund, and we've got this wonderful triangle, this wonderful calculator where they can figure out what they wish to do. They can design it themselves.
Correct.
So really, it's up to the investor. If they have the time and inclination, they can buy your research reports and they can decide what to do. If they don't quite have the time and inclination, they should come to Quantum, in my view.
That's great. Ajit and Chirag, thank you so much for sharing your valuable insights. I'm sure viewers will immensely benefit out of this. Thank you for watching.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.